Markets have been on a high, and today morning the markets were trading at 12,800 in India, and global markets are up. Another vaccine company, Moderna, has said that they have a vaccine which is 94.5% successful on its patients. Markets are reacting as if the vaccine has been manufactured, cleared by FDA and distributed, and everybody has taken a shot and they are going to go back to normal. The reality is there are no ICU beds in cities like Paris, adding another 500 ICU beds, and the whole thing is in bad shape. By the time the vaccine is manufactured, tested, distributed, it will be by the end of this year at the earliest, before the world market starts to look normal. By the end of this year, I mean end of 2021, not the 50 days in 2020. So the earliest you can look back to a normal life is something in 22-23. Like Pranab said, let's look at the reality, and welcome back to Be Rich. The reality is what Pranab Sen told us, that this year we are going to be at minus 10% GDP. Only corporate readings have shown that the first quarter GDP is down 23%. RBI is already forecasting only on corporates a downward shift of minus 8.6%. The third quarter might be slightly negative and the fourth quarter slightly positive. All in all, India will have between minus 9 to minus 11% GDP growth. There has been a lot of cheer about the earnings uptick in the second quarter in India. Well, I have some news for you. Most of these earnings are on falling revenues and exceptional incomes. Exceptional income is companies have sold assets and downsized and shown profits. They have cut costs ruthlessly and thrown a lot of people out of jobs. What is driving the market is liquidity, and liquidity is finding its way to Indian shores. And this is why the Reserve Bank is continuously buying dollars, and our reserves are at an all-time high. Reserves can go up two ways. One, by selling our assets to foreigners or borrowing from foreigners. The other is really exporting more and importing less. India is doing the former, China the latter. Our exports have continuously contracted. After a small uptick in September, we have dropped again in October. This clearly shows the forex that we are coming into India is basically selling India cheap, and to keep the value of dollar from not rising, the Reserve Bank is pumping rupees into the system by buying the dollars. Normal wisdom is it would do open market operations and drain this by selling bonds and draining liquidity. But the government is borrowing so much money, the Reserve Bank has to buy bonds and pump more liquidity. So basically we are having a two-way liquidity rise, one to buy dollars, other to buy bonds, so that governments can borrow it less. This is definitely bound to seep into inflation. As we are seeing, both wholesale price index at 1.5 and consumer price index at 7.67 are raging. Last year this time, the wholesale price index was 0. It's already moved up 1.5 points. And consumer price index has really shot through the roof. It has moved from protein to vegetables, vegetables to grains, and from grains now into other commodities such as steel. It's only time before it starts to moving into wage inflation, because services inflation is also raging. Services inflation is what is the rent you are paying and what is the doctor fees and tuition fees that you pay for your kids. If all this is going up, it clearly means that the economy is overheating. Worldwide, as Warren Buffett has pointed out several times, low interest rates have acted as gravity on stock prices. Higher the interest rate, lower the stock prices. Low to zero interest rates worldwide, and interest rates, the lowest interest rates in India by Reserve Bank have meant equity as an asset class has gone through the roof. But rising consumer prices means that Reserve Bank has very little space to cut rates. It paused last time. I expect it to pause next time. there is no way that we are going to meet the inflation target that Reserve Bank has set of 5% for the second half of the year. Overall, inflation for this year is going to be 6%, and I will not be surprised if in between it spikes to 8%, which is twice the Reserve Bank's RBI's rate. But under pressure from the political masters, Reserve Bank is keeping interest rates low. Even though interest rates are low, banks are selective in lending. But like Lord Keynes once said, bankers lend umbrellas to those who don't need. Similarly, banks are not willing to lend money to those who are in desperate need for liquidity. They are continuing to lend money to those who do not want money. So, if you see, deposits in banks are growing faster than credit. And unless credit expands, the Indian economy is not going to go anywhere. As I said a couple of days back, the big problem for the Indian economy is crude. As crude rises, then either the government has to cut the usurious taxes on petrol or diesel or jack up the price of petrol and diesel. It's a catch-22 situation. You cut taxes, then your collections go down and automatically fiscal deficit increases, fueling inflation. If you jack up the prices of petrol and diesel, the prices of all commodities are going to go further increasing inflation. The only way we can see this end is by the Reserve Bank tightening rates. If you are following the Indian index has been kept high by rotating from one sector to the other sector. Originally it was IT and pharma, and after the vaccine, IT and pharma dropped out, and Bajaj Finance did extraordinarily well on that day. Are we to believe that all of Bajaj Finance problems are solved just because a vaccine was found? What is happening is the rich are getting richer because they own hard assets and they don't have a problem, and the poor getting poorer. Even among the rich, there's a K-shaped recovery. The rich like Anil Ambani, who have no money, are drowning, and people like his brother, who have assets to sell, are climbing up the ladders. As I speak, the PBYE ratio for the index is nearing 35. So at 35 times earnings, if you think the market is going to go up further, you are mistaken. Even if the earnings go up 30% next year and come to near normal of 405, even then you are at 30 times earnings. There is no point in buying the stock at this time. So it's better to stay safe and watch from the sidelines rather than jump into the index at this time.
If you are saying that the index is being maintained not artificially, high by sectoral investing, and who's the one who's motivated? If you're saying foreign investors, what is the benefit for a foreign investor?
They have
keep sectorally keep our index.
What will you do if you are getting 20,000 crores? In long term, foreign investors make no money in India. If you look at from 2008 to 2020, in dollar terms, they have lost money. For this year, in terms of dollar terms, as somebody pointed out, they have made less than 2% returns. So what they want is, they want to put in money at 20,000 crores, like after the vaccine has discovered, they have put in something like 23,000 crores. That's about $3 billion. They are hoping that the value of the rupee goes up, they make some short-term gains and they get out. These are not long-term investors.
Okay, then if you see, you're saying awash with liquidity which has come in and we are in a recession. But if you see from 2019, quarter-wise, you keep till now, every quarter we have been going down, dipping, but the index has been doing okay. So the liquidity, what was the reason for the index to be up back then?
No, see, in March of this year is the turning point when the global indexes crashed. The Jerome Powell moved very fast to bring interest rate to zero overnight and pump liquidity into the market. So, if you want to know exactly when this will reverse, there are two ways it can reverse. One is India's inflation goes through the roof. If it crosses 8%, and we have to see what is the effect of base rate, because JFM of last year had high interest rates. If you are able to bring it down to 6, then they will wait for April, May, June and inflation to cross 8 before they act. If the price rise is so high that it overcomes the hurdle of the base rate, and crosses 8%, Reserve Bank will be forced to increase interest rates. The moment the Reserve Bank increases rates, then the markets have to come down, because even before there's a fragile recovery, you are slamming the brakes. So I think first quarter of June next year will be very good, because you had minus 23. You will have a great growth of 15-20% next year, first quarter. After that is when the problems will start. But nobody knows when the end will come. Only we know the end will definitely come. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification. If you use Kindle, you can buy the book using the Kindle link given below. If you want a hard copy, send a message to the WhatsApp number given below and my team would get in touch with you. At the very end, if you want to get in touch with me, please send a mail to berichenglish@gmail.com. I am grateful for your support of Berich.